All right, so thank you everybody for joining us today. We have our wonderful partners from Consumer Financial Protection Bureau here with us. Ms. Laura Udis is going to be presenting on buy now, pay later, rent to own, and payday loans. Laura Udis is the Consumer Financial Protection Bureau's Senior Program Manager, Small Dollar, Marketplace, and Installment Lending. Her work includes pawn, payday, auto, title, installment, earned wage access, and buy now, pay later lending. Prior to joining CFPB, Ms. Udis was the first Assistant Attorney General and Administrator of the Consumer Credit Code in Colorado, and was responsible for the state's non-depository consumer credit regulation program. She also served as the Senior Financial Service Advocate at the Consumer Federation of America. Ms. Udis has a JD from Boston University of Law and a BA in Economics from the University of Colorado. So with that, I will welcome Ms. Udis and turn things over to her.
Thank you. Happy to be here today. And that was much more of an introduction than we needed. And just for reference, my last name is pronounced Udis, but it gets mispronounced all the time. So no worries about that. I'm happy to be here today and talk to you about some of these interesting products that we see in the market. And I'm happy to answer questions at the end. Let me try to share my screen. This one, I think. All right, you can all see that. All right, let me see. What do I need to do? Optimize. But you can see it full screen, is that right?
Yes.
Yes. Okay, excellent. We don't use Zoom that much, so it helps me. Okay, so first, I have to do the disclaimer, and that's anything I say today is not legal advice, does not necessarily constitute an opinion of the CFPB or formal guidance, but anything I say will be my own views. And so let's move on and start getting into some of these products. The first one I wanted to mention was credit repair. And by the way, first of all, thank you for what you all do. And the assistance you provide to others. You may have heard of credit repair. This product typically advertises on late night TV, but credit repair is basically paying a third party to remove inaccurate or obsolete information from your credit report. And a couple things about this. First of all, if the information is accurate, it cannot be removed except with the passage of time, typically 7 years, but for bankruptcy, that can stay on for 10 years. So if a consumer finds an error on their credit report, they can fix it themselves for free. We have information about that on our website, and that's at the bottom of this slide. But in this past September, we put out a consumer advisory about the fact that people can cancel credit repair services and how they can do that cancellation. And also that federal law requires that companies actually perform and achieve results within a certain time frame, and that they cannot collect any advance fees to do that. That's been a problem in the industry. They also have to provide a consumer report or credit report that will show the results. And as I mentioned, consumers can do this themselves for free. They don't have to pay someone to do it. I've also included information about a recent lawsuit, legal case that the CFPB entered into with a large credit repair firm called Lexington Law. And we found violations of a number of the laws that apply here. So some of the interesting things here are that Lexington Law and its related company are banned for 10 years from performing any credit repair activities, and they have to pay $64 million in penalties. All right, moving on to payday loans. What is a payday loan? Payday loan typically refers to a very short loan, short term, small dollar, high cost loan, generally for $500 or less. It's a single payment loan due on your next payday or the date that the consumer receives governmental benefits. So, an important point to remember is that payday loans can also be made against receipt of future government benefits like Social Security. The fees typically range from $10 to $30 per 100 borrowed, and the typical loan amount is about $500. These are high cost loans. This is high cost credit. The typical annual percentage rate, the APR, is 391%, much higher than other types of credit that you might encounter or consumers might encounter, but similar to rates for or for pawn loans and auto title loans, which are similar products. One of the things about a payday loan is that the consumer gives the payday lender either a physical post-dated check to hold until the loan due date, which is on payday, or authorization to electronically debit the person's bank account. So that money is going to come out automatically.
Laura, I think we lost you.
Okay, can you hear me?
Yes, now we can. Your screen is not sharing though.
All right, let me go back. Okay, hopefully that's good.
Yes.
So, great. So, as I mentioned, some states don't permit payday lending directly or have lower APR caps that payday lenders find too low for them to make money. So payday lending is legal in about half of the states in the US. On the federal level, however, while there is no federal rate cap that applies to all consumer loans, if a person is an active duty service member or is a dependent of an active duty service member, then there is a federal rate cap. 36% is the cap for active duty service members and their dependents. And here's information on our website about payday loans, key terms, basics, and other options that is generally helpful for consumers. One of the goals of the CFPB is that we favor credit that is fair, transparent, and competitive. And this tool here, this website that I'm showing now, could help consumers compare other products and see if there are alternatives to payday loans that would be helpful. Now, moving on to earned wage access. And what is earned wage access? Earned wage access is somewhat similar to payday lending in that it enables workers to access a certain amount of their earned but unpaid wages prior to payday. There are two different models. Some earned wage access, or EWA, is offered through an employer. The firm partners with the employer or integrates in the employer's time and attendance records. But there are other options. The other model is a direct to consumer model where earned wage access firms advertise directly to consumers. Now, on the employer partnered model, because of that partnership, the EWA firm has knowledge of and access to time and attendance records and knows exactly how much has been earned to date and what the net pay will be. For direct to consumer products, they don't have that access. And so they typically rely on bank account data to look for recurring direct deposits that they assume are paychecks. And some of them also use geolocation tracking, where the consumer has to enable an app to track them at work to make sure that they have, in fact, put in the required number of hours to get paid out in advance. Funds are repaid on EWA through either automatic payroll deduction through the employer, or on the direct to consumer model, agreements to debit the bank account on payday. There are several fee structures with earned wage access. Some of them are free to consumers. That's very consumer friendly. The reason they might be free is that the employer subsidizes or pays for the cost, um, or the earned wage access provider provides the funds, the money, on a prepaid card. And when the consumer uses that card or debit card, the EWA firm earns what's called interchange revenue. It's a percent of every dollar amount that the consumer pays. But there are other fee models. Some of them require the worker to pay a fee per transaction or a subscription fee monthly, for example. Um, and in addition, there might be fees to receive the EWA instantly, expedited rather than in 1 to 2 business days. And finally, some of the models, primarily the direct to consumer models, will ask or do ask users for a tip. The tips are supposed to be voluntary, but there have been objections raised that sometimes those tips don't seem to be voluntary. Tipping for financial services is not common. And so if there's a tip amount suggested on a checkout page or on a screen, the question is, does the consumer really have a choice there? So that's what EWA is. Now, as far as what the CFPB has done in this area, the first and probably biggest question is whether EWA, earned wage access, is credit. If it's a credit product, there may be additional restrictions, such as cost of credit disclosures required by the Truth in Lending Act and Regulation Z, and the 36% APR that I mentioned under the Military Lending Act for active duty service members and their dependents. And in addition, some states, I mentioned payday lending is legal in about half the states. Some states have interest rate caps. And if earned wage access is credit and there are fees involved that are finance charges, then they could be subject to that state's interest rate cap. But in November of 2020, we issued an advisory opinion that certain earned wage access products are not credit. Those have to be employer partnered, and or the opinion mentioned employer partnered, and set out several other conditions, one of which is that the consumer pays no fees for the product. We have said that we plan to clarify the application of that opinion to products that were not covered or not described in the opinion. And that's one of the work streams that we are working on currently. So let me move on to buy now, pay later. This is an interesting new over the past several years product that I'm guessing that you have seen when you do any online shopping. If we were all in the room, I'd ask for a show of hands. How many of you have used buy now, pay later? But First, let me note that there's no single definition of buy now, pay later. If you think about it, anytime you use, say, a credit card for a purchase or an auto loan, that's a type of buy now, pay later. But what we typically mean is a product, a loan that's a pay in for loan. Typically relatively small amounts. We've done some studies, and I'll go over this, that shows the average amount is about $135. Available at the point of sale, but typically online, not exclusively, however, or on the BNPL provider's app. What this BNPL does is it takes that purchase amount. Let me use 100 for simple math, and splits the payment into 4 equal installments. The first installment, rather unusual for a loan, is actually a down payment due when the consumer makes the purchase, due at checkout. And then the remaining 3 payments are due in 2-week intervals, resulting in a 6-week loan. So a short-term loan, not as short as a payday loan, but a short-term loan. What's rather unique about buy now, pay later is that for the most part, there's no interest, no cost to actually use buy now, pay later, except that if a consumer is late in making one of the remaining 3 installments, they may have to pay a late fee. Although other options are that the buy now, pay later lender just freezes the consumer's account, does not let them make other purchases. And that could be one of the tools to collect if a consumer is late. Buy now, pay later is typically not reported on any consumer credit report. And some of the largest buy now, pay later companies in the US are Affirm, Afterpay, Klarna, Zip, Sezzle. You may have heard of some of those. But again, this is mostly online shopping. So if the consumer pays no interest, and if they're never late, no late fees, how does the buy now, pay later lender earn their money? From merchant fees. Merchants are finding that buy now, pay later is so popular that it increases the amount that consumers spend. It decreases what is called shopping cart abandonment, meaning consumers complete the purchase, again, typically online, don't abandon what's in their cart, and are demanding it. So at checkout, you would typically see online various options to pay, maybe your credit card, maybe PayPal, and then a buy now, pay later company. There are also, I mentioned, at point of sale or on the buy now, pay later app. Some of these companies like Afterpay, Klarna, Affirm have their own app. So, for example, if you wanted to buy some shoes from Nike, you could go to Nike's online website at checkout, select the shoes at checkout. Instead of credit card or PayPal, you could choose to use one of the buy now, pay later firms. But alternatively, if you went to, let's say, Klarna's website, you would see essentially an online shopping mall within their app from various stores, including Nike in this example. And you could buy the shoes directly through the app, the BNPL app, and agree to the 4 payments that way. The BNPL firms require, I mentioned, a down payment and 3 remaining payments. At the time of the purchase, the consumer has to select that all payments will be made by debit card or credit card. There are some options to change the payment method in the future, but the majority of people, about 90% of consumers, are choosing to pay with debit cards. There are some other similar products. If you've used your credit card lately, depending on your credit card, and you spend over a certain amount of money, let's say $100, you might get a note from your credit card company that you have the option to split that payment into installments. But that's post purchase after the point of sale compared to buy now, pay later, which is at the point of sale. Here's some of our website information for consumers about buy now, pay later loans, what they are, how they work, and what we have done with buy now, pay later. Buy now, pay later really took off during the pandemic when people were doing a lot of their purchases online. So we've done some research and data collection. And in September of last year, September 2022, we published a report on the buy now, pay later market. And I'm going to share with you some of the data from that. And then in March, we published another report based on consumer usage surveys. So, some of the findings about buy now, pay later were a lot of consumers are approved for these loans compared to other loans, 73%, which is a high approval rate. I mentioned most consumers choose to use a debit card for the down payment and the remaining three installments, almost 90%. A little over 10% of consumers were charged a late fee in 2021. And charge-offs, meaning loans that were not paid, resulted in about 3.8% of charge-offs in 2021. This slide is really interesting in some ways because it shows this high growth that I mentioned. You can see the first row is the dollar amount of buy now, pay later loans originated in each of these 3 years. In 2019, 16.8 million. In 2021, 180 million. That's more than a 200% growth in each of those years, year over year. And in terms of I'm sorry, that was the number of loans. The dollar amount of the loans has also grown by over 200% from 2019 to 2020 and from 2020 to 2021, the last year for which we have data. Again, the dollar amount's rather small for each buy now, pay later transaction, about $135. Now, usage. This slide's a little complex, but what we have is on the left side, you can see the US population by age based on Census Bureau data. And on the right column, what we see is BNPL usage by that same cohort. So you'll see that the largest share of buy now, pay later users are the light green area, those aged 25 to 33. Likely not a surprise, the darker blues, 51 to 64 and 65 plus. 65 plus in particular, only 2% of the population is using buy now, pay later, although they make up 22% of the population. So the arrows represent over or under usage based on percentage of the US population. But the takeaway is this is a product that's especially popular with those under about 34 or 35 years old, but not exclusively. Also, what is buy now, pay later being used for? Initially, consumers were using buy now, pay later almost exclusively for fashion, for clothing, apparel, for other small items like that. But over time, we see that there's a higher use now with other products, which might include food, restaurants, other small things, small repairs. So apparel, food, or clothing and fashion is still popular, but it's down to about 50% at this point in time. So our report also looked at both benefits and risks to buy now, pay later. First of all, in terms of benefits, buy now, pay later is low cost compared to other alternatives. Um, for example, credit cards. I mentioned that buy now, pay later typically has no interest free, and only has late fees if consumers pay late. Same with credit cards. But credit cards typically charge an interest rate of about 17, 18%. That may be increasing. And if consumers don't pay off their credit cards in full each month, if they revolve, that they're called revolvers, those who don't pay in full each month, they're paying interest and have no grace period for the interest. But buy now, pay later is a product with no interest. There are other benefits to consumers. It's quick, it's easy to use, it involves an almost instantaneous credit decision. I mentioned high approval rates, and it's really simple to understand compared to credit cards where you have a minimum payment due and interest may accrue. With buy now, pay later, it's 4 payments. The cost is split into 4 with no interest. We did, however, also mention potential consumer harms in our report. There are several of them. The first is there's a lack of standardized disclosures on buy now, pay later products. Some buy now, pay later firms, a few, are providing the traditional cost of credit disclosures that you would see if you open a credit card or take out an auto loan, for example, but that's in the minority. There are also dispute resolution challenges. Most buy now, pay later involves online purchases, and I think we all know that there are a high level of returns and disputes in the online purchase marketplace. Items come late, they come damaged, they're not as expected, they don't fit. So there's a number of returns. And with credit cards, consumers can, if they notify the credit card company within the required time frame, they can withhold or stop making the payment on that purchase while the dispute with the merchant is being resolved. But with buy now, pay later, those 3 remaining installments due every 2 weeks continue to be due, and consumers might have to pay those amounts before the dispute is resolved with the merchant and the buy now, pay later firm. So we do see some challenges in the dispute resolution space compared to credit cards. Compulsory use of auto pay is another potential risk. I noted that with buy now, pay later, consumers have to, at the time of purchase, select the payment method for the installments, either debit card or credit card. And that can be challenging to change, or if a consumer is facing a financial issue and does not want that money automatically debited, that can be hard or near impossible to stop, resulting in overdrafts or potentially NSF fees. Some of the other overextension risks I want to focus on, or some of the other risks include overextension, which is what I'd like to focus on. Buy now, pay later is easy to use. It is quick. It has high approval rates. It is online. It's easy to purchase. So there are concerns about loan stacking, which happens when consumers take out more than one buy now, pay later loan at the same time from different lenders, and ends up in over their head, unable to repay some or all of them. The other overextension risk that we are concerned about is what we've called sustained use. And that is a risk that consumers do make those payments, but because they are so interested in future buy now, pay later purchases, they cannot meet their other non-financial obligations. So that's a risk that we have noted. Next slide here. So another risk that we've seen is what we've called data harvesting. It's collecting data about consumers and what they buy and their purchase habits. This is not unique to BNPL. Um, it happens in other industries too, but because so much of this is online and BNPL lenders have access to what consumer purchased and their payment patterns, they may very well be using this data to encourage future shopping and potentially in the future sell the data. We have not seen that yet, but it is a risk. We are concerned about this, and it's part of a larger discussion on consumer privacy. So, after our report was issued a year ago, we put out a list of various next steps that we are working on. And some of these include putting out interpretive guidance or regulation that would require buy now, pay later to function more like credit cards or to give some of the credit card protections in this space. We also mentioned working with the Federal Trade Commission on some of these privacy and data harvesting issues. We also wanted to look at whether it's appropriate for buy now, pay later loans to be furnished to be reported to the nationwide consumer reporting agencies so that other lenders, a mortgage lender, an auto lender, could see a consumer's full financial picture. And some other work streams too. Those are all active work streams at the Bureau. And then in March, our Office of Research put out a report, a survey of BNPL users. And I'll just highlight a few of the findings from that report. Again, on BNPL, which I'm spending a lot of time on, but is an important new area. So probably the most significant part of this report from March of this year is that it looks at the financial profiles of buy now, pay later borrowers compared to non-borrowers and corrects the misconception that buy now, pay later borrowers do not have access to traditional credit. It was thought that some buy now, pay later users might be what are called credit invisibles or don't have credit cards. And so this is an option that is a good option for them. But turning to the findings, we did see that buy now, pay later borrowers are more financially distressed, more financial trouble than non-borrowers, both before and after using buy now, pay later. We don't know if there's a causal relationship here. We don't know if one causes the other, but it's something that we encourage others and we ourselves continue to take a look at. So some of the high level findings from the report, and really it's, again, this is a very detailed slide, but look at the right side, look at the highlights. We see that BNPL users are typically more frequently Black, Hispanic, and female, and their incomes are between about $20,000 and $50,000. They're less likely to have extended education. So it's a negative correlation with having gone to college, having gotten a bachelor's degree. In other words, they seem to have less education. We also saw, again on the right side of the slide, that buy now, pay later borrowers are more likely to have credit cards. Again, that was a fairly unique or unexpected finding, I think, by some. Not only are they more likely to have credit cards, they're more likely to have other credit too. Retail cards, meaning store credit cards, personal loans, auto loans, and student loans. And typically, they are more delinquent or late in making payments on at least one of these loans. Now you can see that in mortgages, they are less likely to have mortgages, more likely to be renters. In addition, we found that not only do they have more credit based on credit that's reported on credit reports, but the dollar amount of their credit and their utilization rates are higher than for non-BNPL borrowers. So they're using credit quite a bit. In addition, they also have used payday loans, pawn loans, for example, have lower savings and liquidity. So this seems to indicate financial difficulties or financial stress by buy now, pay later users. But again, once more, we cannot at this point find a cause and effect relationship. That requires additional study. And just some more highlights on the right side that I don't think we need to go over again at this point. But the big one is that 69% of buy now, pay later borrowers have at least one credit card and are revolving on it. Again, they have credit cards. They meaning buy now, pay later users. And on those credit cards, they're paying interest at between 19 and 24%. So using a zero interest buy now, pay later product may be very appealing to some consumers. And then finally, I don't have a particular slide on this, but I wanted to mention rent to own. And you may be familiar with it. Rent to own is typically a product that borrowers with poor credit, subprime credit, may be tempted to use. It's a way to purchase goods that you might otherwise buy using a credit card or using cash, but typically for larger amounts of money that consumers don't have cash for all at once. Rent to own, and some of the larger rent to own players are Rent-A-Center and Aaron's Rent to Own. Consumers typically go to a store to rent furniture, appliances, computers, electronics, but there are even rent to own wedding rings and rent to own automobile tires, almost any product you can think of. It can also be done online. Rent to own is typically viewed as more expensive than paying with a credit card or cash or buy now, pay later. Prices are typically higher than you would see at, say, a big box retail store. And rent to own payments are typically due compared to a loan payment. Rent to own payments are typically due every weekly, whereas most loan payments are due monthly. Buy now, pay later payments are due every 2 weeks. There are also fees involved, sometimes delivery fees to deliver the item, setup fees to set up the account, late fees or missed payment fees. But what's rather unique about rent to own is that the consumer, the user, is not obligated to make all payments under the contract. It's generally a month-to-month contract. The consumer can stop anytime. For example, if they run into financial difficulties, they do not have to complete the contract. It will not be reported on their credit report. But the downside is that they will have to return the property or it will be repossessed, physically repossessed. And consumers lose all equity, meaning all payments they have made to date. So that if they wanted to start again in a few months when their financial situation is better, they would often start again from installment number one, weekly installment number one. But this option to cancel at any time without remaining legally obligated on the contract means that if a consumer is unable to pay, there's no debt collection, there's no reporting of the contract on their credit report. But it will be typically much more expensive than other options for consumers. And rent to own is somewhat regulated by state law. And some states do have restrictions on the prices that can be charged, but others do not. So that's the end of the information I wanted to share with you today. But I hope you have some questions or want to chat about some of these items. And I will stop sharing at this point, and we can open it up for discussion.
Wonderful. Thank you, Laura. I appreciate all of that information. Does anyone have any questions? You can either unmute if you'd like or put them in the chat.
I see there's something in the chat about Apple. Yes, Apple recently announced its buy now, pay later option called Apple Pay Later, which is a 4-payment buy now, pay later option. What's interesting about Apple, and it's not even been live for a year, the Apple Pay in 4 or Pay Later, is that Apple says that they will report or furnish these 4-payment loans to the big 3 consumer reporting agencies, Experian, Equifax, and TransUnion. That will be new. To date, there's only one other buy now, pay later firm called Sezzle that will report payments, negative and positive, but consumers have to opt in for that. So Sezzle doesn't report all BNPL payments. It's this voluntary opt-in. But yeah, thanks for the note about Apple. That's potentially a very large competitor for some of the other firms that I mentioned.
Are there any other questions or comments?
I mean, one question I had was, are you all seeing buy now, pay later? Are you seeing people use that? Has that risen in your view, or is that something that's still pretty rare among the consumers that you work with?
Oh, Susan, I think you're, yeah, there you go.
Yeah, I was trying to unmute. Yeah, I see buy now, pay later, with furniture here, because I work in a housing place and, or a housing complex. And so I see there's a number of people who, yeah, they'll buy a whole suite, a whole apartment worth of furniture because they don't have to, they can buy it over time. And, I see the statistics and the demographics in your, I think it fits in. I mean, with the people I know who have bought suites worth of furniture, yeah, they're struggling, with other debt and managing debt. And but one thing that I was curious about is this debt consolidation or the payoff business for consumers to they negotiate away a percentage of their credit card debt. And they're paying over time with a go-between agency. And then what happens is when they believe they've completed that debt repayment with that credit card, the credit card contacts them about continuing to make payments on the part that they thought they negotiated away. Can you explain this? Have you heard this before?
Well, let me try to answer some of it. But first, I'll just mention you mentioned the furniture with buy now, pay later. Some people have called buy now, pay later reverse layaway. For those of you like my generation or a little older, you might remember layaway, where you'd make the payments over time and then you got the product. But buy now, pay later might be viewed as the reverse layaway, because you get the product and you pay over time. Although, again, that's similar to using a credit card or other options. But as far as debt settlement, that's an area that we cover as well. Typically, a debt settlement company will advertise that you need at least $10,000. If you have $10,000 or more in credit card debt, they will negotiate or settle your debt with your creditors. Often they claim for 50 cents on the dollar or less. There are some potential risks. The first risk is that they tell you to stop making payments to your creditors, to your lenders, if you have not already. So if you're struggling but making payments, you're better off from a credit report point of view than if you stop making payments. If you stop making payments, which you're advised to do typically, your credit score, your credit report will reflect even more negative options, more late fees. The lender could sue you. And but sometimes now we see debt settlement companies soliciting consumers before they're late, before they are in default. Now, it is true that some debt settlement companies are successful in negotiating settlement.
Laura, I think we lost you again.
I just had a problem there again. The other potential problems are that, lost my train of thought there, that the debt settlement company may not be able to settle your debt. And most consumers, if in distress, can talk to their creditors directly or through a counselor. And somewhat well known that credit card companies will generally work with consumers if consumer cannot pay and is struggling. They would rather work with the consumer than a debt settlement company. But we do take complaints on debt settlement companies. It's not one of the areas that I directly cover, but we do take complaints, and we have brought actions against various debt settlement companies for unfair, deceptive, and abusive practices.
Thank you.
Yeah, and Chelsea, I see you have your hand up. Do you want to come off mute and ask your question? Maybe chat it. I see you're off mute, but we still can't hear you for some reason. So maybe chat your question in. And there is a question in the chat from Pam. She says payday loans are not in every state. What states? And then the loans are criminal in their rates.
Yeah, I can email you a list of the states. Rather than go one by one right now, which I don't have in my head. In general, payday loans are legal in the South, the Southeast, Texas. They're generally prohibited or have a very low interest rate in the Northeast. Even though I just said they're generally prohibited or generally permitted in the South and Southeast. Georgia, for example, criminalizes payday lending, says payday lending is a crime. So it's not allowed in Georgia. It seems every year or so, a few states will, through their state legislature or the ballot initiative process, set an interest rate cap. Minnesota just did that this year, 36% interest rate cap that will take effect January 1st. But some other states like California, where you might think payday lending is illegal, is not the case. Payday lending is legal in California. So it really varies by state, but I can send you a map, or I can send it to Nina, a map of the states, and that might be helpful for you. I'll write myself a note on that.
Yeah, and any resources you could share that I can send out to everybody would be helpful. I'm not sure if you're able to share it, but a copy of the PowerPoint would be awesome as well.
Yes.
And then Chelsea did chat in her question. She said, when negotiating debt, isn't the amount that does not have to be paid back treated as a charge-off, resulting in damage to a credit score?
Yeah, could be. It definitely could be. When a debt is forgiven, so for example, if you negotiate with a debt collector to pay only a certain amount, or a debt settlement company, that could result in taxable income as a forgiven debt, based on IRS rules. And so that's another very important, thank you, very important point for consumers to think about, is they might have to report that amount forgiven as taxable income and pay income taxes on it.
Well, thank you everybody for your questions. Is there anyone else that had anything they wanted to ask quickly or comment on? Not seeing any hands raised.
Oh, and I see I didn't quite answer that one question correctly. Now that I see it in the chat, the question was not about the amount forgiven being taxable income, but could it, which it is, or could be, but does it hurt your credit score? And probably yes. The failure to pay, the late fees, the delinquency before any settlement is made will typically hurt most consumers' credit scores. And the fact that it was repaid, but after charge off, which is typically 90 days or 120 days past due, the fact that it was charged off, even if repaid eventually, yes, can also likely negatively impacts a credit score.
Chelsea followed up with, she feels like most people that receive this assistance do not realize the detriment.
Yeah, it's challenging when people are having financial trouble. They may see a lot of advertisements and be very tempted, and maybe we hope the first place they look at is counselors, CFPB, state attorneys general, FTC, but we know a lot of people are desperate and believe the ads they might see on TV, or what they see on their phone.
I have a question about the actual interest rates themselves on credit cards. Wasn't there some regulation about usury and these double digit, I don't know, interest rates? I mean, when did things change?
Oh, that's a little beyond me, but here's what I know. Again, there's no national federal limit on interest rates except for military borrowers and their dependents, that 36%. It's a good question. It's a good question. For years, interest rates have been in the double digits when the prime rate, other bank borrowing rates were down at 2 and 3%. And we don't really see much movement in interest rates. They seem to have hovered between, I guess I would say, and I don't cover interest rates for the Bureau, but my personal recollection is they've hovered between about 13% and 27, 28% for years. And yet credit card companies also have charged annual fees in some cases, credit card late fees. You may know that we have a proposal out. CFPB has a proposal out to lower the amount of permitted credit card late fees to $8, and from the typical 2 or 3 times that amount. So that's about all I can say on credit card fees, but I have noticed that trend as well.
We have one more question in the chat. How do you find a legitimate or reputable credit counselor in your local area, and does a list of such companies exist?
I believe, and I don't know if they changed their name. There's a group that used to be called, again, this is not something I directly deal with, the National Foundation for Credit Counseling, NFCC. And members of that, I believe they've changed their name. I'll email it to you. But credit counselors who work with the creditors and consumers to stop using their credit cards, to freeze or hold the amount of interest, to try to lower the amount, and provide educational services as well as ways to actually pay off the debt. But let me find out. I'm almost positive they changed their name. Some of you may know, but I will email that to you. Okay, thank you, Chelsea.
All right, so with that, it is 2 o'clock. If there's any other questions, feel free to reach out to me and I can connect you with Laura. I will email all of you the resources and the PowerPoint that Laura went over today once I get that information. So if you are interested in that, please keep an eye out on your email. We will also post the recording on our YouTube channel sometime later this week. So thank you all so much. Thank you, Ms. Laura, for your time. We appreciate it.
Thank you. Sorry I kept cutting in and out.
Oh, that's all right.
I enjoyed it. Thank you.
Yes, thank you. Have a great day.